Hey folks, this is Mansoor Suhail from the Accounting and Tax. We are cross-border tax specialists located in Toronto, Canada. In this presentation, I'm going to cover tax filing requirements for non-residents with Canadian rental income. It's a clear guide that covers all the steps that are involved in filing requirements for non-resident rental income from Canada. So let's get started. Tax filing requirements for non-residents with Canadian rental property can be complex and very confusing. As a non-resident who owns rental property in Canada, it is important to understand your tax obligations to avoid penalties and compliance issues. This presentation will provide you an overview of the tax filing requirements for non-residents with Canadian rental property, including information on non-resident tax rates, filing a Canadian income tax return, and seeking professional help. First, it is important to understand what it means to be a non-resident for tax purposes. Non-residents are individuals who do not reside in Canada for more than 183 days in a given tax year. If you are a non-resident who owns rental property in Canada, you are required to file a Canadian income tax return and report your rental income to the Canada Revenue Agency. Failure to do so can result in penalties and legal issues. In addition to filing a Canadian income tax return, non-residents with Canadian rental property may be subject to non-resident tax rates. The CRA requires the payer or agent of rental income to withhold 25% of the gross rental income paid or credited to non-residents. However, there are tax treaties and agreements between Canada and other countries that may reduce or eliminate the non-resident tax rate. It is important to understand the tax treaty between your country of residence and Canada to ensure you are paying the correct amount of taxes. So here are the key takeaways. Non-residents who own rental property in Canada must file a Canadian income tax return and report their rental income to the CRA. The CRA requires the payer or agent of rental income to withhold 25% of the gross rental income paid or credited to non-residents. But tax treaties and agreements may reduce or eliminate this rate. Seeking professional help can ensure compliance with tax filing requirements and avoid penalties. Let us talk about understanding the non-resident status. When it comes to tax filing requirements for non-residents with Canadian rental property, it is essential to first understand what it means to be a non-resident. According to the Canadian government, an individual is considered a non-resident for tax purposes if they normally, customarily, or routinely live in another country and are not considered a resident of Canada. So, to determine residency status, the Canadian government considers several factors, including residential ties to Canada, such as home, spouse, or dependents, the purpose and duration of any visits to Canada, employment and business ties to Canada, social ties to Canada, such as memberships in Canadian organizations or participation in Canadian cultural activities. If an individual is deemed to a non-resident, they are only required to pay Canadian income tax on income earned in Canada. However, they are not eligible for certain tax benefits and credits, such as the Canada Child Benefit. It is important to note that even if an individual is considered a non-resident for tax purposes, they may still be required to file a Canadian tax return if they have Canadian rental property. This is because rental income is considered Canadian source income and is subject to Canadian income tax. In summary, understanding non-resident status is essential for those with Canadian rental property. Non-residents may still be required to file a Canadian tax return if they earn rental income in Canada, even if they are not eligible for certain tax benefits and credits. Let's talk about Canadian rental property ownership. Non-residents who own rental property in Canada have specific tax filing requirements that they must follow. The payer, such as a tenant or property manager, is responsible for withholding non-resident tax at a rate of 25% on the gross rental income paid or credited to the owner. The payer must remit the withholding tax to the Canada Revenue Agency on or before the 15th day of the following month that the rental income applies. Failing to remit the tax will lead to penalties and interest on the non-resident tax amount. The Canadian income tax on rental income is calculated as 25% of the gross rental revenue and is required to be withheld by Canadian agent of the non-resident. However, the CRA will allow the non-resident to pay tax on the net rental income if they file a tax return within the prescribed time. Once approved, the property manager or agent can withhold the non-resident tax of 25% on the owner's net income. Taxes are due on the 15th day of the following month after rental income is paid to the owner. If the non-resident owner is a deemed non-resident of Canada under a tax treaty between Canada and another country or region, they must file a tax return under Section 216 of the Canadian Income Tax Act. The section allows non-resident owners to pay tax on the net rental income instead of the gross rental revenue. The non-resident owner must apply to the CRA for approval under Section 216. Once approved, they must file under Section 216 for that year, despite receiving a refund or owing any money. It is important to note that non-resident owners are also subject to capital gains tax on the sale of Canadian rental property. The capital gains tax rate is 25% of the gain on the sale of the property. However, non-resident owners may be eligible for a reduced capital gains tax rate under a tax treaty between Canada and their country of residence. In summary, non-residents who own rental property in Canada must follow specific tax filing requirements. The payer is responsible for withholding non-resident tax at a rate of 25% on the gross rental income paid or credited to the owner. Non-resident owners may apply to the CRA for approval under Section 216 to pay tax on the net rental income instead of the gross rental revenue. Non-resident owners are also subject to capital gains tax on the sale of Canadian rental property. Let's discuss tax obligations for non-residents. Non-residents who own rental property in Canada have tax obligations they must meet. The Canada Revenue Agency, CRA for short, requires non-residents to file an income tax return for each year they receive rental income from Canadian sources. Non-residents must also pay non-resident tax on their rental income, which is calculated as a percentage of the gross rental income received. The non-resident tax rate is 25% of the gross rental income, unless a tax treaty between Canada and the non-resident's home country reduces the rate. Non-residents who own rental property in Canada must obtain a Canadian Tax Identification Number, TIN for short, from the CRA. The TIN is required to file a tax return and to pay any taxes owed. Non-residents can apply for a TIN by submitting Form T1261, Application for a Canada Revenue Agency Individual Tax Number for non-residents. However, if the non-resident has a Canadian tax advisor and applies for a waiver, the withholding tax rate can be reduced to reflect the non-resident's actual tax liability. It is important for non-residents to be aware of their tax obligations and comply with Canadian tax laws to avoid penalties and interest charges. Non-residents should consult with a Canadian tax advisor to ensure they are meeting their tax obligations and taking advantages of any available tax treaty benefits. Filing a Canadian income tax return. Non-residents who earn rental income from Canadian property must file a Canadian income tax return. The following subsections will discuss how to determine rental income, expenses and deductions, and how to fill out Form NR4. Determining rental income. Non-residents must report all rental income earned in Canada on their Canadian income tax return. Rental income includes rent, fees, and other amounts received for the use of a property. Non-residents must convert their rental income into Canadian dollars using the exchange rate on the day they received the income. Let's talk about expenses and deductions. Non-residents can claim expenses related to earning rental income, such as property taxes, insurance, maintenance, and repairs. However, non-residents cannot claim capital cost on their Canadian income tax return. Non-residents can also deduct rental losses from their Canadian income tax return, but the amount of the loss cannot exceed the amount of rental income earned in Canada. Non-residents can carry forward rental losses to future years if they are unable to deduct them in the current year. What is Form NR4? Non-residents who earn rental income from Canadian property must also fill out Form NR4, which is used to report payments made to non-residents. The form includes information such as the non-resident's name, address, and country of residence, as well as the amount of rental income paid to the non-resident. Non-residents must also provide their Canadian withholding tax identification number on Form NR4. If a non-resident does not have a WTN, they must apply for one by filing out Form 1261. In conclusion, non-residents who earn rental income from Canadian property must file a Canadian income tax return, report their rental income in Canadian dollars, claim expenses related to earning rental income, and fill out Form NR4 to report payments made to non-residents. Let us discuss non-resident tax rates. Non-resident landlords in Canada are subject to tax on rental income received from Canadian sources. The rental income is taxed at a flat rate of 25% of the gross rental income, with no deductions allowed. Non-resident landlords can, however, apply for a waiver to reduce the withholding tax rate to 25% of the net rental income, subject to certain conditions. The waiver is available to non-resident landlords who have filed a Canadian tax return for the previous year and who expect to have a rental loss or rental income that is less than 25% of the gross rental income. The waiver can be obtained by filing Form NR6, which is a request to have the 25% withholding tax reduced to an amount that reflects the actual tax liability. If the non-resident landlord fails to file Form NR6, the withholding tax will be calculated at the default rate of 25% of the gross rental income. This withholding tax is a final tax, meaning that the non-resident landlord is not required to file a Canadian tax return unless they have other Canadian source income. It is important to note that non-resident landlords who receive rental income from Canada may also be subject to tax in their country of residence, depending on the tax laws in that country. It is recommended that non-resident landlords seek advice from a tax professional in both Canada and their country of residence to ensure that they are compliant with all tax laws. In summary, non-resident landlords in Canada are subject to a flat rate of 25% withholding tax on rental income received from Canadian sources. However, they can apply for a waiver to reduce the withholding tax rate to 25% of the net rental income, subject to certain conditions. It is important to seek advice from a tax professional to ensure compliance with all tax laws in Canada and their country of residence. Tax treaties and agreements. Non-residents of Canada who receive rental income from Canadian property may be subject to Canadian income tax. However, Canada has tax treaties and agreements with many countries to prevent double taxation and to determine which country has the right to tax certain income. These treaties and agreements outline the rules for determining residency, the types of income that are taxable, and the rates of tax that apply. If a non-resident's country of residence has a tax treaty or agreement with Canada, they may be able to claim certain exemptions or deductions in Canadian tax. The Internal Tax Service Office provides information on tax treaties and agreements for residents of Canada and non-residents. Non-residents can contact the ITSO if they have a question related to how their Canadian source income will be taxed in Canada. It is important to note that the rules and provisions of tax treaties and agreements can vary depending on the specific treaty and the countries involved. Non-residents with Canadian rental property should consult the relevant treaty or agreement and seek professional advice to ensure they are meeting their tax obligations and taking advantage of any available exemptions or reductions. In addition to tax treaties and agreements, non-residents may also be subject to Canadian withholding tax on certain types of income, such as rent or royalties. The amount of withholding tax depends on the type of income and the country of residence of the recipient. Non-residents providing services in Canada may also be subject to withholding tax under Regulation 105. The Canada Revenue Agency provides information on required withholding amounts for non-residents providing services in Canada. Let's talk about penalties for non-compliance. Non-resident individuals who own rental property in Canada are required to file a Canadian income tax return and report their rental income. Failure to comply with these filing requirements can result in penalties and interest charges. The Canada Revenue Agency, CRA, may charge a penalty of 5% of the unpaid tax for the first year of non-compliance, plus an additional 1% for each month the return is late, up to a maximum of 12 months. If a non-resident knowingly fails to file a tax return, the penalty can increase to 50% of the unpaid tax. In addition to penalties, the CRA may also charge interest on any unpaid tax. The interest rate is currently set at 5% compounded daily and is charged on any balance owing starting on the day after the tax filing deadline. Non-resident individuals who fail to report their rental income may also be subject to penalties under the non-resident withholding tax rules. The payer of the rental income is required to withhold a certain amount of tax and remit it to the CRA on behalf of the non-resident. If the non-resident fails to report the rental income on their tax return, they may be subject to a penalty of 10% of the gross rental income. It is important for non-resident individuals to comply with Canadian tax filing requirements to avoid penalties and interest charges. The CRA has various tools at its disposal to enforce compliance, including the ability to garnish wages and seize assets. Let us talk about seeking professional help. Navigating the tax filing requirements for non-residents with Canadian rental property can be challenging. Seeking professional help can make the process much smoother and ensure that all necessary forms are completed correctly. There are many reasons why a non-resident may require professional tax services. For example, a non-resident may not be familiar with Canadian tax laws and regulations, or they may not have the time or resources to complete the necessary paperwork themselves. Additionally, non-residents with rental property may require assistance with determining their rental income and expenses, calculating their tax liability, and submitting their tax returns. When choosing a professional tax service, it is important to select a provider like us who has experience working with non-residents and rental property. A tax accountant like ourselves can provide specialized services for non-residents with Canadian rental property. We can also assist you with other tax-related issues, such as GST/HST filing requirements for non-residents providing services to Canadian residents. Working with a professional tax service like us can also help non-residents avoid costly mistakes and penalties. Non-residents who fail to file their tax returns on time or accurately report their rental income and expenses may be subject to fines, interest charges, and other penalties. Overall, seeking professional help can make the tax filing process less stressful and ensure that non-residents with Canadian rental property are in compliance with Canadian tax laws and regulations. Let us discuss some frequently asked questions. What are the tax implications for non-residents with rental property in Canada? Non-residents who own rental properties in Canada are subject to Canadian income tax on the rental income earned from those properties. The rental income is subject to a withholding tax of 25% of the gross rental income. Non-residents can claim deductions for expenses related to the rental property, such as property taxes, insurance, and maintenance costs. What is the filing deadline for NR6 forms? Non-residents who own rental property in Canada must file an NR6 form with the Canada Revenue Agency before the first rental income payment is due. The NR6 form allows non-residents to pay tax on their net rental income rather than the gross rental income. The filing deadline for the NR6 form is 30 days before the first rental income payment is due. What is the difference between NR4 and NR6 form? What is the difference between NR4 and NR6 forms? The NR4 form is used to report income paid to non-residents, including rental income. The NR6 form, on the other hand, is used by non-residents who own rental property in Canada to pay tax on their net rental income. The NR6 form must be filed before the first rental income payment is due, while the NR form is filed after the end of the year. Do non-resident Canadians have to file Canadian tax return? Non-residents who earn rental income from Canadian properties are required to file a Canadian tax return. The tax return must be filed by June 30th of the following year. Non-residents can claim deductions for expenses related to the rental property, such as property taxes, insurance, and maintenance costs. What is the tax rate for non-resident rental income in Canada? Non-residents who earn rental income from Canadian properties are subject to a withholding tax of 25% of the gross rental income. However, non-residents can claim deductions for expenses related to the rental property, such as property taxes, insurance, and maintenance costs, which can reduce the amount of tax owed. How do I report rental income for non-residents on my tax return? Non-residents who earn rental income from Canadian properties must report the income on their Canadian tax return. The rental income is reported on Form T1159, which is included with the non-resident's Canadian tax return. Non-residents can claim their deductions for expenses related to the rental property, such as property taxes, insurance, and maintenance costs on the same form. So folks, should you have any questions, visit us at www.theaccountingandtax.com or call us at 416-283-8774 and we will be glad to help you with your non-resident tax issues if you are earning rental income from Canada as a non-resident.